Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Wednesday, and you know what that means. It means our longest running guest, Anna Kelly, is back with us. How you doing, Anna?
I'm doing great today. Good to be with you.
Thank you for being with us. Thank you for inspiring our expert series. It wouldn't be here without you. You have your playlist, hundreds of hours of Anna and I talking, almost 2.5 years, I think.
It's gone by so fast and it's so fun.
Yeah, I look forward to every Wednesday. So you put out a note in Facebook yesterday. I have taken it, put it in Word, and I'm going to pull it up in here in a minute. But do you want to kind of share your mindset when you took the time to put that note together before I pull it up?
Sure. I've been thinking a lot about where we are in the economy, what could be on the horizon, and what do we do as investors to think about these things. And you and I've talked about it a bit over the last couple of weeks, but essentially the world keeps getting curiouser and curiouser, right? And there's so many changes that we've seen in the last couple of years that have really changed some of the foundations of things that are happening in the US economy, such that we need to look back in the past to learn from it. But the more I study, the more I realize, Michael, that we're in completely different financial paradigms with intricacies in the financial system, ties to other countries. We're much more dependent on other countries like China, like Russia, for a lot of what we need in order to produce what we produce. And we import a lot more than we export. And so all of those things, when the war happened with Russia and Ukraine, and China kind of rose up and said, we're kind of backing Russia. We're not going to join it, but we're not going to do anything about it. It made me go, you know what? There's something to what Ray Dalio was challenging us about in Principles for Dealing with the Changing World Order and the rising of kind of this Chinese empire and the US potentially being on the downside of our greatness, particularly economically and with all of our debt. Yeah. So, I've really been cautious. I'm normally an optimist. I'm not betting against America, right? But to Dalio's point, there's things that we need to wake up and understand that, quite frankly, most experts that talk about the economy don't talk about, don't understand. And I realized that even though I've been investing for 24 years in real estate, for 25 or 26 now in traditional investments with uber wealthy, all kinds of investments, the more I know that I really don't know where we're headed. And it's okay to tell people that, right? Yeah. And to think about, what do we learn? What is different this time? What are kind of the possibilities and probabilities that play out in terms of where the US economy is headed? And then how do we use what we think may happen to hedge and protect asset preservation, what we've already built, and also potentially use to our advantage to continue to make money if and when things get bad, right? So I've been thinking about this so much and really trying to kind of play chess with myself. If this goes here, what do I do? What do we change about our portfolio? And so that's what precipitated me posting.
Yeah, I could agree with you more, right? This is our first pandemic. This is our first inflation of 10%. Certainly we were kids when this happened last time. It happened around us. We weren't really impacted. But yeah, it is, it's a very interesting time. So let me pull this up because I agree with you. And I just love how your brain works. Because it's like, I agree. This is all chess, right?
Yes.
So I put this in Word. I don't know. What do you think? Do you think we read it? Do you want to take it in chunks? What do you think we do?
Sure. Do you want me to read it?
Oh, sure. Why not? You're the author. Can you see it okay?
I can.
Awesome.
Okay, great. It's like a teleprompter for me. It's awesome. Okay. So after the Great Recession of 2009, Americans have experienced the longest expansion and growth period in history, watching wealth grow, asset prices climb, and seemingly unending prosperity. While there were signs of another recession in 2018 and 2019, the Federal Reserve's quantitative easing and low interest rate policies kept the economy purring and people buying. But these moves created money from thin air and made it easier for people, businesses, and governments to go into debt in order to consume, produce, and make greater returns. Then the pandemic closed businesses and society as a whole, and we were in a technical recession. So the Fed printed more money and gave it to everyone so that we would keep spending. Most of us who studied economics warned that this would cause hyperinflation and recession sooner and later. And by the way, Michael and I did too, right?
Yes, absolutely.
I doubt anyone, including us, anticipated how quickly that would actually happen.
Mhm.
So we're now watching inflation hitting 10%, the highest in almost 50 years, as well as a stock market correction, real estate at all-time highs, and an unthinkable war by a ruthless dictator. This will cause our government to go into further debt, and inflation will hurt the poor and the middle class the most.
Yeah.
I'll stop there, and then we can talk about what investors are thinking and wondering about.
Yeah, I think all of that is awesome. And I do think we break this down. So this is kind of a perfect snapshot. I don't think a lot of people realize, I like you, I think we were on the cusp of a natural business recession. Kind of like the end of 19, as I felt like the last domino was going that direction. And then obviously the world changed in late January and February.
Yes.
And then we just printed all this money at $6 to $7 trillion. It was literally the great helicopter experiment.
Yes.
Right? Not only do you have all this money, but oh, by the way, you don't have to pay these bills either. Right. So, I mean, it was all, and that's why we have excess savings. One of the things that annoys me, and I've said it a couple of times, is everybody talks about the consumer like they're one bucket. And the trait, the one that really gets me is the consumer has $1.4 trillion in excess savings. Statistically speaking, that is right. However, when you look at the average or the traditional like individual, I don't believe that's anywhere close. I think, I don't know about you, but if I had to guess, I would guess the top 10% has 90% or more of this excess savings, dry powder, all of that stuff. So
Yes.
it is, I don't think the consumer is healthy. And you saw retail sales this morning, below expectations, adjusted for inflation, negative. It's all about gas. It's not about stuff. Stuff was down. So I don't buy this BS that the consumer is healthy.
You are so right. And I have looked at statistics, and they're changing rapidly, but about 50%, the lower 50% of income earners in the United States only hold about 2% of the wealth in the United States.
Oh.
So that's like a fact, right? And the average household has about $4,000 saved, 4,000. Now, when the government gave everybody a bunch of money during the pandemic, I know a lot of people started saving more. I've seen tenants who had unemployment, an extra $600 a week, and still didn't pay because they were saving. Mm-hmm. I've heard people who say, oh, I have a foreclosure moratorium, so I'm not paying my mortgage. So they're saving up money. And what are they doing? They're shopping, they're buying things. Well, eventually that money runs out, and it has run out, and no more is coming. And so a lot of those people were not natural savers, and I don't think saved a lot of it. We saw that they were spending it, which is part of why we have significant inflation, because everybody was spending, but what people have left, if their behavior hasn't changed since what they had pre-pandemic, they're spending everything they have and they have nothing left. And that's why inflation hurts the poor and the middle class so much, because prices go up and they simply already aren't saving enough to be able to absorb the additional cost increases.
Yeah, I mean, I believe that inflation has been and always will be a monetary phenomenon, right? And what we did is we essentially created money, put it in the system. Not only did we create money, but again, folks, we told people not to pay some bills, which when you look at the bottom line is excess savings or, in my opinion, excess spending. So that's why Amazon and Etsy and Peloton and all these other retailers were blowing it out last year.
Yes.
It's because people weren't paying their mortgage. They weren't paying their rent. They got extra this, extra that. And now that's all gone. And this 1.4 trillion savings that people are talking to save us, that's the rich with dry powder looking to, buy some stuff on the cheap.
Right. But here's the other thing that's really important about that. And I don't think a lot of people really understand and appreciate this, is after the last financial crisis, the 2009 Great Recession, we really put in a new era of quantitative easing and interest rates being kept tremendously low. And essentially the Federal Reserve, the people who sit on the Federal Reserve are kind of cheekishly called hawks or doves, right? So hawks hate inflation. And since they hate inflation, they want to raise interest rates to keep inflation down. Doves are called doves because they supposedly care more about people. And because they care more about people, they want to give them lots of free stuff and free money. And so the way you do that is you keep money super, super cheap, even though you know that inflation could happen. So somewhere in the middle, we've got what we call these hawks and these doves that make monetary policy. But essentially what happened after 2009 is all but one guy, we can go into this maybe a little bit later, but all but one guy on the Fed, after pumping in a lot of money into the system to kind of save the economy in 2009, which everybody went along with. That's the time when the Fed really needed to take action, and they lowered rates and they pumped a bunch of money into the system by buying back a bunch of bonds that nobody else wanted, right? So when they put all this money in the system, Michael, they did two things. One, they made it really cheap to borrow, okay? So companies and consumers, they wanted us to keep spending, to keep us going into a deep depression, even though we were already in a recession. And what that did was it made people start spending more, just like what we're seeing now. But the other thing that it did that I didn't really appreciate until I was really studying it a lot recently is that by them doing quantitative easing, basically they started putting money into the system on a balance sheet and saying, go make these loans, go do these bonds, and then we'll buy them from you. So the government basically kept rates so low that banks and companies were no longer incentivized to save money because they could save money at 1 or 2%, or they could borrow money at 2 or 3% and go buy stuff on debt that creates a greater yield. So businesses built their companies up over the last 10 years, and we've seen the stock market go up because of this. They poured a lot more money into their businesses. Consumers had a lot more money to spend and were buying, but now there's this huge debt and balance sheet that is variable. And so if rates go up, this could really hurt a lot of companies. So I know you mentioned companies are saving all this money, but the reality is it's only recent that they're starting to do it because they're afraid of the inflation and the interest rate hikes. So they're starting to sell a bunch of assets to get liquid in preparation for a recession that they know is coming, and being able to dig out of their debt if they have to start paying down principal on some of this debt. So it's a tremendous crisis. We do not have a lot of savings. That's a natural savings phenomenon. We have companies finally going, oh my goodness, inflation is home to roost. We have too much debt. We've got to sell and liquidate. And that's the reason people have savings right now.
I couldn't agree more. Kind of wrapping this first part up, I think there's too many companies. It is so similar to the .com era. Too many companies have lived off debt, right? They're functionally insolvent, right? They lose money with every widget they sell. And the only reason they can pay their bills is because they can go to the bond market or the stock market and issue more shares. Party's over. I talked to some companies that are in pre-IPO, and it's like, money's not there anymore. Companies are gonna have to start making like earnings, like actually have a PE instead of, not NA, not applicable because they don't have any earnings. So it's going to be a very different time. So
absolutely.
All right. So let's go back to, because you got so much here. Let's keep going.
Awesome. So many investors are wondering what comes next and how to both hedge risk and protect our families, our income, and our wealth, and to make the most of coming opportunities. So what I know is this: there's a lot that I know and there's a lot that I don't, right?
Yeah.
What I know is, as I said earlier, the longer I've worked with investments, both in real estate and in the traditional financial sector, the more I know that I still don't fully understand all the complexities of the financial system. And that's important because if we come from a place of arrogance, like we know what the Fed's going to do, they're going to raise rates and it's going to be fine. And don't bet against the US. We won't go into recession. It won't be deep. Those kind of statements are based on pride of a short window of time. And as you and I mentioned, we're both in our 40s, I believe. I'm 47. And so I was a baby, in the 70s and the early 80s. And I remember, it being really tight, and I grew up really poor, but I really didn't know what caused the 1970s inflation.
Yeah.
And so many people assume that everything today is going to be just like it was back then, and it's easy, and it's not, right?
Yep.
The more I know after studying the economy and listening to much older, wiser investors and economists that have been around for multiple cycles, the more I know that a lot of experts today also don't fully understand the economy.
Yeah.
And that's why they argue over, do we raise rates or do we not? How much? Is inflation transitory? Is it not? How do we keep from going into a recession? Do we care if we go into a recession? They really don't know. A lot of them just are not studied into history. And I can see that daily. And the more I know of history of the Fed, which I've really just been studying more and more over the last couple of years, and the US economy and global economics, the more I know that the past, while it's helpful to study, is not as complex as the present, and that the factors and reactions to those factors in the past are very different from those we're facing today. The factors that are different today and these red herring, not thought of events like COVID-19, and importantly, the convergence of numerous events, each of which can trigger financial issues, will cause different things than we expect by looking at the past paradigms and the tools of the Fed for controlling those financial things in the economy. So these complexities are likely to bring unique results and the potential for what I believe are painful results, more painful results than monetary policies implemented in 2009 and since that intended to fix the economy might actually lead to. All this to say, the Fed Reserve and rates set now today can only control a small piece of the complex financial issues we're facing. The Fed only has 2 or 3 tools in the tool belt, and the primary tool is manipulating interest rates. When interest rates are low, money is cheap and demand is high. When demand is higher than supply, which is seriously constrained due to the pandemic and now the war, inflation results. The Fed cannot fix the supply side of the supply and demand fundamentals, which result in price increases and decreases in everything. So they must attempt to squash demand. The only way they know to do this is significantly raise interest rates. And as a result, I expect rates to rise substantially in the next year or two. I would guess at least 2%, but I think probably more.
Yeah, I want to talk about that.
Yeah.
Because when I read that the first time, so I'm like, rise substantially. In my mind's like 3, 4, 5%. And then you come back and say, oh, you're saying at least 2%. So that's the minimum. Okay.
Yes. And the reason I say that, Michael, is again, we talked about, we have these hawks and we have these doves, right?
Sure.
And not everybody is on the same page at the Fed. And we talked last week about, what will Powell do? Will he be more hawkish or will he be more dovish? And, how is he going to react, right? Not everybody is on the same page as to what is best for the US economy. Some say inflation is so bad, we have to squash it. And even though that'll put us in a recession, it'll kind of eventually stop the bleeding, allow us to start producing again and climb back out. And so those that are hawkish and hate inflation, they feel like recession is a necessary evil to squash it, right? But those that are dovish are saying, listen, there's already a huge wealth gap, which, by the way, the Fed in 2009 helped to make worse, right?
They were blown on that bubble.
Absolutely. And so the poor are being hurt the worst. So the doves are going to come in and say, listen, we cannot crush the lower class, the middle class. If we raise rates too high and a recession is too deep, we go back to mass unemployment. Government has to come up with more money to help people, and they don't want to or are not able to do that too. So I think that those doves, Michael, could keep the interest rates from going up as high as they did in the 70s, or at least over the next 2 years, trying to keep it to no more than about 2%, hoping that all these other factors kind of work themselves out and they don't have to go up into double-digit interest rates. I really have no idea where that's going to go, depending on how the Fed votes, but they seem to be a little less hawkish and saying, we still kind of think this could be over soon, and we need to be slow and methodical.
Yeah, I'm gonna throw out there, because I'm gonna say at least 3%. I think I'm more hawkish. Yeah,
I am too, but I wanted to be sound too alarmist, right?
No, I got you. That was one question I had. So, okay, go ahead. We're almost done.
Yes. So this will kill parts of the economy, and it must. The Fed has to be careful not to kill all parts of the economy at once and too quickly. And that's really important.
Yes.
The result of high inflation is high rates. The result of high rates is a slowing economy. The result of a slowing economy is a recession. With the US in unprecedented debt and our reserve currency status being threatened, adding a war and more government debt to help defend Ukraine, which I do fully support, will make it much harder for the Fed to control inflation. Maybe we stop there before we keep going on to China and Russia.
Yeah, I think, there are very few things that I know for certain after studying economics for 30 years. And I think you've highlighted them here. High inflation leads to high rates. High rates leads to slowing economy, which I call demand destruction. Same thing.
Yes.
The slowing economy results in a recession. I got to tell you, at this point where we are, Anna, I believe a recession is a requirement. This whole idea of a soft landing might be something that is possible in a normal cycle. We are not in a normal cycle. We were heading into a normal cycle in 19.
Yes.
It got exacerbated by 2 years of $6 trillion. I don't think a soft landing is possible. I think you rip the damn Band-Aid off. You have a deep recession, maybe, for us, deep really is, -4, -5% GDP growth. You just got to get it over with. I think this messing around with quarter point here, quarter point there, it's going to hurt longer, and ultimately you still have to pay the price. And it's
right. And that's the difficulty, and the difficulty of the Fed. And I don't pretend to be smart enough to know exactly what they should do, right? But what I can tell is that we are in a different situation now than we were in 2008 and 9. While everyone wants to go back and say, well, this is what they did in 8 and 9, we'll just continue what we've done before. That doesn't work anymore. And, part of the problem is, for the first time in history that I believe, for the first time in history, the Fed, the US government is a net debtor. We're a net borrower by trillions and trillions and trillions of dollars. The last I read, it was like 10 trillion due today, but they don't talk about the fact that we have trillions that we already have promised in future debt well above that, right? So in 2008 and 2009, we were not in trillions and trillions of dollars of debt as the US government. So they were able to bail out essentially companies like I worked for, AIG, and try to keep the system propped up. In the pandemic, we were trillions in debt, but we continued to print more, which is part of why we're here, like we talked about earlier on. The challenge, I think, Michael, for letting the system go into a deep recession today, if I'm thinking through this properly, right, is that now we cause mass unemployment. Because what happens in a recession, right, is that demand comes down so much that all these products that are more expensive, they have to keep coming down, even though there's a supply chain issue, because nobody wants to buy them anymore. So to continue to sell and keep their businesses going, they have to start lowering prices. And with wage increases the way that they have been, they're going to start laying off all these people whose wages they increased, and we have mass unemployment. The challenge today, we're already out of COVID funds that have been helping those that were unemployed previously, right? So the government has so much debt now that we did not have in 2008 and 2009, that if we cause a deep recession, the US government doesn't have enough money to help people that are on unemployment. So they have to be very, very careful about letting unemployment get too high, which is what happens when you go into a long and deep recession. So, part of the question is, stagflation isn't a good thing, right? It's like a stagnated economy with some inflation, but the Fed's not going to be able to totally squash inflation right away. So do they try to keep us in a stagflation environment without going into deep recession? Or are they trying to stair step it, that so-called soft landing? And how do we get out of it without everybody being tremendously hurt, other than wealthy people who have the money to be able to try to hedge it?
Yeah. It's damned as you do, damned if you don't at this point. I don't think there is a good outcome. I think the good outcome was lost a year ago when they didn't do anything. They didn't raise rates a year ago.
Right.
At this point, you've got the ingredients in the soup. You got to eat the soup, and
right.
It's not going to taste good.
And it pains me to say that. I mean, I'm pro US. I'm pro. I want everything to get better, right?
Yeah, of course.
And I'm an optimist. I mean, I'm still investing today. I've sold a lot. I'm doing a lot to hedge it, but I'm still investing in real estate today because real estate's been an amazing hedge through recessions in the past, and I believe that it will be again, right? But the point being, I think we have to be a little bit pessimistic and understand that these things are not just transitory and going to go away really quickly, right? We have to be a little bit pessimistic by seeing that these things can cause a lot of pain and then figuring out what we do about it. So the other just real quick thing, high level, and I won't read it here, but in terms of China. So I have to admit, you were talking about the Chinese real estate bubble a few months ago and all of that crashing. And I said, Michael, I really don't pay attention to what's happening in the Chinese economy at all, right? And one of the things that I said early on was the more I know I don't, right? And in 2009, I realized even though I worked for AIG in a division that sold credit default swaps, I didn't understand a thing about them or how them and mortgage-backed securities could squash a financial system. So I learned to become a student of the economy, but primarily I've been studying the US economy. And while I understand that we have trade and imports and exports with China, and Donald Trump wanted to stop that and play hardball, I didn't really understand how dependent the United States is now on China for exports of a lot of substantial things, like 90% of our pharmaceuticals and computer chips and things of that nature. But because of this war with Ukraine, and I really learned this from reading Dalio, and then I've been avidly reading about it for weeks since then, is that when Russia went to war with Ukraine, China basically said, we stand with you, right? Because China wants Taiwan. And there was a news article that came out yesterday that someone in China it was a Russian government guy leaked in Russia that China was going to attack Taiwan in the fall, and that they basically were going to do it together this year. So they're kind of watching, how is the US going to react to Ukraine? Is this a good idea or not? But I have strong concerns now, and admittedly, I don't know enough about it, but that we are really beholden to China for a significant amount of our gross domestic product. They produce more GDP than we do on a net basis. And so we're relying on them for a lot of the things we produce. They have the components. And so if we get into a trade war with China, which we already are, and then you add these, military hot and cold wars, and what we're seeing with sanctions, what happens with China could have a huge impact to an already teetering US economy. And the thing is, Michael, China and Russia know that, right? So if we're drawn into war, it's very expensive, and we're already starting to spend money again that we don't have to help defend Ukraine. So while I believe that's the right thing to do as a country that defends freedom and justice and takes care of people, it's a very expensive thing for the US government to do as well when we don't have money. And so I think we cannot have this conversation without basically pointing out that what's happening in the war, although yes, it's mostly about the people there, and I'm not trying to make this about America, but it will impact American economy more than what I think most people realize, and far more than I ever realized until recently.
Yeah, I think that could be its own conversation. And maybe we'll get to that in the second session. I did want to close with what your advice was. I thought that was very powerful, so I highlighted it here for you.
Great. So here's my advice for what it's worth, right? Take my 2 cents. Study the economy and how our relationships with debt and other countries impact the economy. It is huge for us to understand what to do in real estate. You can't just listen to real estate investors and look at the US real estate economy. You have to look at everything from a macroeconomic standpoint. Get liquid. This is really hard when inflation is eating away every dollar. And it's something that I've been wrestling with. How do I get liquid, prepare for this downturn, but not let inflation destroy, 10 cents out of every dollar in the meantime? And then buy assets that are recession resilient. Do this in a diversified way, right? I'm not going to buy all multifamily properties in Hershey, Pennsylvania. I'm going to buy some single family properties that have fixed debt. I'm going to buy some vacation rentals. I'm going to buy properties in Texas and Georgia and Tennessee and Florida and Pennsylvania. I want to be diversified with what I'm buying. But hear me on this, right? Real estate is one of the best recession resilient investments you can make. I am not saying be so fearful that you stop investing.
Right.
Keep investing, but do it wisely, right? And then get out of bridge debt. This is so important. And it is going to hurt so many people. In 2009, the people that were destroyed and bankrupted in real estate were almost all in hard money, bridge loans, temporary debt that resets and comes due very quickly.
Amen.
Commercial investors in bridge debt right now on large apartment buildings. Be careful. Be careful. I'm not doing a lot of large multifamily deals right now because the numbers require bridge debt, and I'm not willing to do that at this point. So to that point, Warren Buffett is credited with this. He says, be fearful when others are greedy and be greedy when others are fearful. So people are still greedy right now. We are not at the fear point yet. The markets might be a little bit, right? But they're kind of bipolar. They don't know if they're up or down on whatever day it is, right? So we're not yet at the point of the bottom and fear. So we need to be a little fearful while everybody else is greedy. Then when things do get really bad, don't panic. That's the point for us to get greedy and go, okay, now that we're liquid, what do we go buy? Because we know things are going to get better in a few years, right?
Amen.
Surround yourself with people who are older and wiser than you are. This was a mistake that I made in 2009. I didn't know anybody to talk to. I didn't know what to do and I had to figure it out. And it took me years. Now I surround myself with other people that have been through these things and say, what are you doing? How are you hedging? How do you view these things? The next things are just be good to others. People are hurting all around you. And for those of us who have created financial freedom through real estate, we are tremendously fortunate and tremendously blessed. And I remember 10 years ago being on the other side of that, being the poor and the hurting. And there's a lot of people that are poor and are going to be hurting even more so when we hit a recession. So just continue to be good to people, be good to your tenants if you're a landlord. This is huge. I believe in prayer and we have to pray every day for wisdom. I pray for God to protect me from making poor investments that are too risky, to give me wisdom to study the past and, try to figure out what's happening and make the best decisions I can. Pray for Ukraine, pray for our world, pray for peace, and pray for a better tomorrow. And that I do. And that I think is my biggest takeaway is we need to be wise. We need to pray. We need to talk to others and just be really careful.
Yes, folks, and you need to follow, Anna Kelly. Anna, how can people follow you?
Great, thank you so much. You can follow me on social media, Anna Kelly, REI Mom. If you're interested in multifamily investments where we make a difference in our communities for accredited investors, you can find me at greaterpurposecapital.com.
Thank you so much.
Thank you, Michael.